And now let's talk about what is a business case. I expect everyone has been involved in a business case some part of your career. You may have been someone who led the entire process, but certainly we've all been indirectly involved in providing data to a business case. And so what is a business case? Obviously, it's a tool that you want to use to understand what is going to be the financial impact and also non-financial impact of making a change in your organization. Again, it could be organizational change. It could be technology change. And of course, we're focused today on automating the P2P process. So we're going to talk a lot about how a business case applies to that. It obviously informs your decision process to really say, how is this change going to positively improve the business? But again, a business case sometimes is similar to a hypothesis, right? So, when do you write it? You write a business case, create a business case when you're in a planning stage of a change in your organization. And you want that business case to guide you in terms of what is the true opportunity, justify this choice you're making around strategic direction change. Of course, why you write it, it's really the backbone for your guidance. It's explaining the reasons for the change. It's enabling the change with very specific guidance around what is expected in terms of improvements to the business. The word change gets a lot of focus. Change is good. If you're not changing, you're not improving. Unfortunately, the business case doesn't get the same accolades, but a business case is critical and super important to have. So again, I'm going to be talking about Hackett's approach to creating a business case. Let's look at the 8 steps of building a business case. And for those of you who are very confident, I'm hoping this is similar to yours. You may have more steps, fewer steps, but I expect that you cover off in your business plan approach all these key factors. So we're going to look at determining the approach and of course, why are you doing a business case? You want to identify desired outcomes. You need to create your baselines, what your scenarios are, what's going to be the scope and timing. So step 2 is, what are the assumptions? What is the scope of this change you're making, this implementation? What are the financials, baseline financials, of course, the timing, the business drivers. The third step is looking at benefits. Is this going to increase your sales and revenues? Is it going to have a cost reduction? It may be a combination of both. Is it going to increase your working capital efficiency? Then, of course, there's intangibles. So we're going to talk about the hard benefits and soft benefits. Then you want to make sure that you identify all the costs that are going to be associated with this project. Operating expenses, capital expenditures. You're going to look at and calculate your financial impact. So again, your very traditional financial metrics around net present value, your expected time of payback, your internal rate of return. You'll have those very traditional hard financial figures as part of your business case. Then a very important step, number 6, is doing your sensitivity and your risk analysis. So looking back on those assumptions that you developed in step 2 and the benefits that you expect to achieve, now you start doing what-if scenarios and create some ranges of opportunity. And this is a super important step because you want to be realistic. The 7th step is determining non-financial impact. Is this going to make an improvement to supplier relationships? Is it going to impact customer experience, employee experience? And then, of course, you want to summarize it all together. What is the conclusion and what is the recommendations? And again, appreciate that sometimes a business case similar to a hypothesis proves out that we need to take a different direction, or maybe this is not the right thing, or it makes you go back and sharpen the pencil. And again, not go back just to change things to make it look better, but go back and sharpen the pencil and say, let's relook at our assumptions. Are they realistic in order to make the right conclusion and recommendations? So we're going to start with step number 1, determining your approach. Like I said, similar to creating a hypothesis, following the scientific method, very similar approach. Again, what you're looking to do is create a justification, a rational methodology and determination about the change that you want to make. What's really important in this step is you're looking at the timing of your benefits, and you want to be realistic about that. Certainly, we all want to immediately achieve results, instant gratification. Well, sometimes you have to be realistic and know that change is good, but sometimes the wheels move slow. So you want to be realistic about the timing of the benefits. When are the costs going to occur? Some are going to come very quickly. Some may be slower. Same thing with your assumptions around revenue growth. It may not happen immediately. So again, realistic baseline. That's really super important, is create a realistic point of view of where you are today and what the impact of initiatives are that are even in flight. Sometimes organizations, we're probably all a bit guilty of this, is taking credit for things that are already happening and building it into the business case when those benefits were going to happen anyway. So you really want to focus on realistic point of view and baseline. Now, the second step is going to be developing your assumptions. Your assumptions that you're creating are going to be looking at the timing, so the time period that is part of the business case analysis. Geographically, where are you making this change? Is it just in one region? Is it just in one business unit? So you're defining specifically as part of your business case what's going to be impacted within your organization. And again, sometimes your business case will have multiple layers. You are planning to do a change in implementation that eventually will be global. It's a really good approach to do these steps by region, by your phase implementation. So you're being another layer down of realistic. You may not achieve the same benefits and you may not have the same assumptions region by region. So it's really good to have this broken down by your planned approach of implementation. The third step is determining benefits. And this one, again, the guidance here is it always going to be realistic. Now we're getting into more of the exciting parts because this is like what we're going to achieve. We get excited about this, but we have to keep staying grounded. Is there going to be an increase of sales? And or if we're looking at spend control, is there going to be a reduction in spend for the organization? How is the project going to affect cost improvements, whether it's cost of goods or expenses to the organization? What is the realistic figures? Of course, what we're starting right now is we're just gathering what do we believe the sources of those benefits are going to be. Is this going to help revenue? Is it going to reduce spend? Is it going to affect things like working capital? Number two on our list of focus right after eliminate manual work, everyone said we're also looking at cash flow. Right? So it's very important to understand, is this going to improve our working capital? And of course, that is a big factor when organizations are looking at accounts payable solutions, is that it's going to give us much better control and visibility about our disbursements, outgoing cash. Now we're going to dig down even a little more. Cost reduction can be viewed in two perspectives, and I expect many of you on today's call are focused on the accounts payable process, procurement process. There's always two key areas that procurement looks at, and that's your hard savings, your expense reduction. For example, you've renegotiated a contract and you've got more favorable pricing in that contract. That's going to be a hard savings. That's an expense reduction that you can take to the bank. The other one is softer savings, which is a cost avoidance. But equally important to highlight, if you're a procurement professional working with suppliers, or again, when you're looking at a business case and what do you expect a benefit to be, there could be a cost avoidance. So you want to also factor in that component. Both types of those costs are important to include. And what's really important is to be able to define it, to be able to explain it, because you must get buy-in. This is a cross-functional exercise where you need to get buy-in from senior leadership and, of course, key stakeholders that are part of the organization, the region, the process that this change is going to affect. You need to get the buy-in, and if you can't clearly define and explain what you put into the business case, it's very challenging to get that buy-in, or worst case is, at the end of it, you don't have people that are shaking their head in the same way and saying this is a good change because they weren't part of the development of your business case. Data sources. So of course, the greatest source of information is going to be within your organization. How has this process operated and been measured in the past? Hopefully you've got some good data around the process, the function that you're making a change to look at that historical performance. Of course, the other area to look at is externally. How do we compare to others? There's lots of ways, not just Hackett, but many others that you can go to gather some external benchmarking data to say, here's where we are today, here's where we want to get to. Is this realistic? So looking internal as well as external is super important. So step number 4 is now the cost. We've looked at all the benefits. We're excited about what we are hoping to get. Now we need to also be realistic about what is this really going to cost us? Because at the end of the day, no different than, managing our own home expenses in checkbook, we can get excited about something, but then we have to realize that there's costs associated with it. You need to look at your cost types, hard and software perspective. So, obviously we're talking technology. There's going to be costs associated with the upfront installation. There's going to be maintenance costs potentially as well. We need to understand the structure of how the expense of the software will occur, have it included in here realistically, talk about our timeline. So it should look not just as when we turn on the switch, but long term, is the cost going to stay aligned with the benefits? Will the benefits continue to exceed? We need to look at internal labor costs, external, all the costs associated with, if we're bringing in partners, third parties, that needs to be included. The one that I probably on the slide should have made in a bigger font and bright is training. Training before, during, and after, change management before, during, and after. So that is an expense that you need to consider and a cost that you really want to make sure you're doing your change management focus. And that's going to drive adoption of your change. And it also factors in, of course, into those expected benefits. Because if you're not getting the adoption, the change, you're not going to see the expected benefits that you would put into your business case. Step number 5, you definitely have to have the financial model looked at. And it's got to align with what the baseline is today and what your scenarios are. And of course, we're showing just one. You may have multiple scenarios depending on what you expect the variability to be of your assumptions that you've created. So again, traditional things that we would expect to see in here. You're going to look at, you have your net present value, your payback period, your internal rate of return. All those things are going to be expected to be part of this. And again, cash flows. Really understanding cash flow. So we can look at balance sheets and P&Ls. Those are super important. But I think, I'm not sure who coined the phrase, but you can run a business at a loss for a while, but you can only run out of cash one time. So you got to make sure your cash flows are aligned. And again, realistic in terms of what you expect your cash inflows and outflows to be relative to your business case and your change. Number 6, I mentioned early on, step number 6 is a super important one. I would say it's one that needs more time spent on it. Not enough scenarios and playing with the business case is typically done. Unfortunately, sometimes it's done at the end when it should have been done sooner. But this is where you're going to spend time looking at your assumptions you've made, how those assumptions relate to your benefits and your costs, and do some what if and sensitivity analysis. I couldn't think of a better way to say it, but you don't want to assume that your assumptions won't change. So you want to test them all. And, even a small one that you think isn't going to have a big effect, if it changes, it may have a great effect. So you really want to play with every one of them and do a what if, what's reasonable in terms of an expectation of something changing internally or externally. Will costs go up by X%? Will you get pressure on your pricing in the market by X%? And so expected improvement to revenue isn't going to be as great. What does that mean to the business case? So play with all of those assumptions that you've created and flow it through to see how it's going to affect the benefits and the costs that you've built into your case. And number 7 is determining non-financial impacts. So of course, this is the area that gets my finance and accounting colleagues less excited, but still super important. And more organizations are looking at the element of experience. Hackett traditionally has always looked at efficiency and effectiveness as a measurement of digital world class. We also now look at experience. That's part of our model for determining performance. And so the change you're making, how is it going to affect customer satisfaction, employee satisfaction? Is it going to improve data accuracy? More and more organizations are very focused on master data management and understanding how a change you're making, especially in technology, is it going to drive faster, more accurate data to the business that's, of course, then used for analytics, for reporting, for decision making? So that data accuracy, non-financial impact, but a super important one to factor into your business case. And again, this is going to be informing your conclusions and your recommendations, and it's going to be observed. You want to look at it and measure it. And I'm about to talk in a moment about measurement and a balanced scorecard. And a balanced scorecard, of course, has both financial metrics and non-financial operational metrics in it. And so again, the final step in your process in the business case is summarizing your findings. You want to tie them back to the overall purpose of the business case. So again, it's almost like, I mentioned hypothesis. It's almost like creating, if some of you have gone through the process of writing a thesis paper, it's that thorough. And many of you said that you're very confident around your process. So I'm expecting many of you take it all the way through this to the end where you're summarizing the findings. And sometimes it doesn't prove out, right? And a good business case, a realistic business case, sometimes is not as attractive as you hoped, and if you're being realistic. So you really want to always be sharpening that pencil, making sure it's accurate. What is changing? Because again, sometimes the business case process takes on a life of its own. And I'm going to talk in a minute about some things you want to keep it simple, but you want to make sure the business case is aligned with its purpose of looking at a change and proving out, is that change effective? And the business case carries on, right? The business case doesn't get put in the drawer. You continue to look at it and say, okay, now we're actually in implementation. How is the activities happening, the costs, the changes in benefits? How is that comparing back to our business case? So use that sensitivity and risk analysis to create the recommendations, but then you're also going to use that ongoing as you move into implementation. So summarizing the critical success factors. I mentioned earlier about having stakeholder involvement, support, buy-in. So super important. This is a cross-functional approach. You want to have a business case advisory board, so people that are invested in this. You may be going to some people with just a request for data. It's important that they know, why are you asking for it? So of course, for two reasons, right? So they know there's potential for change and improvement in a process they're involved in, but you also want to make sure they're giving you good data. You want to make sure that, hey, I want to see some key metrics around our past cycle times, our past matching rates, our on-time payment rates, because I'm building a business case. I want to see if the change we're considering is going to have a positive effect around those key metrics. So you want to get good data and have buy-in from the people that are going to be affected by the change. The content and structure, you want to have a focus on cash flow, as mentioned. Number two, that everyone's focused on. Super important to align the timing of the costs and the benefits and to continue to look back at that. Benefits, again, hard savings, soft savings, tangible and intangible benefits and effects you want to be looking at. Make it simple. Don't turn your business case process into a project of its own. You should be focused on creating a conclusion and a set of recommendations to then move on. So sometimes business cases go on for far too long. And that what if scenario, can't say enough about doing the sensitivity and being realistic about what you expect not only improvements to be, but what if you don't achieve certain levels? Build that into your sensitivity. So now I want to talk about metrics and a management framework. The reason I want to talk about this is because it's really foundational to a business case. If your organization isn't measuring things today, before you really can do a lot of the steps that I talked about, you need this critical data. So process metrics are critical input to your business case. And of course, even if you're not in a position today where you're looking at a change, you still need to know what your performance is, right? How do you compare? Is there areas to make improvements? So if you're not measuring, you really can't even tell if there's an opportunity for improvement. So the reason for a management framework is to have that clear linkage of measures to a strategy. So your goal is to have better spend control. Your goal, obviously, everyone's goal is good cost management. You have to have that framework for how you're measuring that. And so that framework is balanced. A good balanced scorecard has both financial as well as operational metrics. So yes, you're going to have in the area of accounts payable, you're going to know staffing and cost per unit, cost of the overall team, and you're going to look at that for comparison purposes. You'll look at your process costs of AP as a percent of spend, so you can compare that externally. But you really need to know how are we doing from a financial perspective, but then of course operational. And how do they relate? What's driving certain points of pain in the process? And how can that be improved? And of course, again, eliminating manual work. So if you're very manual, you're going to be, we picked a nice word, you're going to be a traditional organization in P2P. It's less mature, right? You're going to be a lot of manual activities. You're not going to be automated. You're going to have a lot of perceived control. So perceived control is, hey, we do everything on a three-way match. We require approvals on everything because we're very manual and there's no way to control it otherwise. So there's a perceived control. What is the relationship to a traditional organization with financial metrics? Our data proves it out. They're going to have more staff. They're going to cost more. Their cost per units are going to be more. Their cost per spend is going to be more. So as you advance here and you start to learn about best practices, you're comparing, you're improving, you're advancing your processes in P2P towards being a top performer. one of the cornerstones is very automated. So you've eliminated a lot of manual work. The work has actually shifted away from transactional to more knowledge-based and controls, but the controls, of course, are not all through a match. It's controls around what is our buy, pen, and pay strategy from an end-to-end perspective. And you've created a culture, an environment of process improvement, process management. You're measuring those metrics that were hard to find when you're creating a business case. They're available all the time, probably online on a dashboard. So that's what a top performer looks like. And holistically, okay, again, what gets measured is not only what matters, but it also drives behavior. It influences behavior. And you want to have that cascaded dashboard of measures from top level. So your stakeholders, your senior leaders have a quick snapshot of how are we looking at a cost level? How are we looking at a staffing level? Things that usually get a spotlight shined on them when you're doing annual business planning and budgeting. And of course, again, critical input into a business case, because we're always looking to improve those. How do we compare? Well, how does it compare to last year, 2 years ago, 3 years ago? How does it compare externally? But as you can see, you want to be able to cascade your set of metrics all the way down to the transactional level. And what's important and how do we measure our teams that are doing the sourcing activity, the buying activity, the paying activity, and holistically have an end-to-end process with measures from start to end and understand what influences them. Does a policy change influence it? Does a change in process influence it? And of course, one of the greatest opportunities is how does digital tools influence it?